Hi everyone, welcome to our DAT IQ Weekly Market Update. This is our update for October 15, episode 312. I'm Dean Croak, Market Analyst here at DAT, along with co-host Chad Kennedy and special guest today, Paul Bingham, Director Global Intelligence and Analytics at S&P Global Market Intelligence. Morning guys, great to be with you.
Morning.
Likewise.
Chad,
Morning.
how did you make out with Hurricane Milton last week? You're right in the center of it.
Yeah, our family made out well, so I'm thankful for that. But we had a lot of friends and family that are, still trying to clean up and move some water out of their property. So It's been a rough one. It's been a rough year.
Yeah, you're saying before the show you're on high ground. What does high ground mean in the context of the center of Florida?
We maybe a couple hundred feet above sea level, but yeah, my neighborhood is the Highlands, so it's there are some hills in Florida, but not many. I'm about 30 miles inland from Tampa. In Lakeland. I'm sure most of our audience knows where Lakeland is, a major shipping market. But yeah, so we had some rough winds, a lot of rain, a lot of flooding that folks are having to deal with.
Yeah, I think in terms of the damage estimates, we're still trying to evaluate what that looks like. But I think on the produce side, there's going to be substantial damage to the citrus crop, according to early estimates. Paul, we caught up at the Journal of Commerce Inland Conference. How did you recover after that exciting event?
Yeah, well, pretty well. I stayed on the road for a few days, but it was great to be there. So much good conversation and a lot of insight. Looking forward to next year.
Yeah. So for those that don't know you and IHS Markit, tell us a little bit about yourself and what you do there.
So I'm in transportation consulting, which is anchored in our economic and market statistics data within the S&P Global Market Intelligence division. S&P has many divisions. Many people know Standard & Poor's for either stock indexes like the S&P 500 or debt ratings in the ratings division. We're actually in a different group, which is anchored in financial and economic statistics. And I'm in the group that focuses on freight transportation, commodity flows, supply chain, mostly from a North American perspective.
Right. Yeah, you had one of the more interesting sessions, I think, anyway, at Inland with Larry and Bill and Lee, I think you might have had Lee.
Yeah, we had Lee from Bloomberg join us for the panel.
Yeah, it was a great session. So, all right, we'll bring you back in a little bit later to talk more about that in detail. In the meantime, we'll get into the freight market update. The market flattened out a little bit last week in terms of spot rates after the pre-positioning of freight volume ahead of the last two hurricanes. So things calmed down a little bit. I expect that to change, though, as we get into the rebuilding effort. NOAA came out last May and said that they expect about 17 to 25 named storms. They are sticking with their assessment of an above average season. So we've got till the end of November to go. Of the 17 to 25 forecast storms, we've had 13 already. Of the 8 to 13 that were forecast to become hurricanes, we've had 9. And that included in the forecast 4 to 7 major hurricanes. We've had 4 already. So some of the preliminary estimates, AccuWeather put Milton somewhere between 170 and 180 billion. That's on top of the damage that Hurricane Helene caused in Georgia and Florida, where they estimate 1/3 of the state's cotton crop is a total loss and about 30% of the peanut crop has been destroyed. Of course, it's peanut harvesting season as we speak. And about 50,000 pecan orchards have been severely damaged, not to mention poultry. About 200 chicken houses were also affected. So lots of damage down there in the Georgia and Florida markets. Ari Asher's Journal of Commerce Intermodal Savings Index. Not much change here in the last few months. The index shows that intermodal shippers on the contract freight side are still saving around 30% compared to rates offered by truckload carriers across 122 lanes. The average length of haul here in the index is about 1,600 miles, so it's mostly long haul. But the range of index miles, really short haul, Atlanta to Orlando, 440 miles, and as far as 3,000 miles for intermodal moves from Miami to Stockton, California. On the spot market side, shippers are saving around 23%. Compared to truckload spot carriers. It's also Thanksgiving in Canada. A special happy Thanksgiving to all of our Canadian customers and friends. In tonight's market update that'll be published at dat.com/market update, we're talking about Elkhart Indiana. It's the RV capital of the world and a bellwether for the US economy. The latest LMI index from Zach Rogers, we're talking about the California citrus season, how that's shaped up, and the latest on the ISM PMI index, how it affects flatbed carriers. So let's dive into the market update and start with dry van load to truck ratio. Load post volumes eased last week, down about 14%. Volumes are around 2% higher than last year, of course, boosted by some of the pre-hurricane surge in positioning of freight, particularly in the southeast. Equipment posts mostly flat. Load to truck ratio at 3.78. That's the third highest since last year. About a third higher than last year. In the refrigerated load to truck ratio, load post decreased by the same as dry van, 14%. Equipment posts down about 3%, load to truck ratio down to 5.42. In flatbed, the number of national flatbed load posts was down 5% last week. It's about 27% higher than last year, though, of course, boosted by some of the higher volumes we're seeing around the hurricane-affected southeast. Equipment posts up 8% last week, load to truck ratio down to 13.54. That's about 54% higher than last year's load to truck ratio for week 41. In the spot rate section of the report, the national average dry van spot rate stayed flat at $1.65 last week. It's about 7 cents a mile higher than last year. There was a 2% increase in the volume of loads moved, but line haul rates dropped in the southeast by about 6 cents a mile following the prior week's 10 cent per mile gain. Of course, a lot of carriers returned to the market as roads in the southeast became more passable. In Florida, outbound volumes in the Lakeland market, where Chad is, dropped by 24% week over week. Inbound dropped by 27% week over week. You'll recall last week they were up by about the same amounts in the lead up to Hurricane Milton. Atlanta to Lakeland, one of our busier lanes in dry van, volume of loads moved down about 22% last week. In the refrigerated market, the national average reefer line haul rate was down a penny per mile, undoing the previous week's increase as carriers came back into the market and the similar reopening of roads occurred in the southeast. At $1.96 per mile, remember these are line haul rates excluding fuel, at $1.96 per mile, rates are 6 cents a mile higher than last year. In the larger Atlanta freight market, rates fell by 14 cents a mile to $1.97, even though the volume of loads increased in volume by about 4%. Our biggest reefer lane in the spot market is Atlanta to Lakeland. Of course, that's exactly where Hurricane Milton passed. Volumes were down 34% last week while the hurricane made its way across the state. Rates down 22 cents per mile last week. So we expect that to sort of come back up this week as that market opens back up. And in flatbed, line haul rates remained flat last week, sitting around the $2 per mile mark for the last 2 months. At just over $1.99 per mile. The national average last week's about 11 cents a mile higher than last year and 6 cents a mile lower than in 2017. That's the yellow line on the chart. Of course, that was back in 17 when the freight economy was improving. Flatbed volumes nationally increased by 3% last week, and they're up almost 18% in the large Atlanta freight market, which is, of course, a big distribution hub for flatbed carriers. We're seeing a similar sorts of decline in freight volumes into Lakeland last week out of Atlanta. Volumes were down 20% week over week on that lane, while capacity was extremely tight following last week's 41 cent per mile week over week increase in line haul rates on that lane. All right, so let's have a look at our forecasts. These are our short-term forecasts out 35 days. We've got a new format, as you will have seen in the last few weeks. We're using Ratecast based on rate view. So we're predicting what Ratecast will be out 35 days. You'll see a couple of colors there, 3 colors. In fact, the green is what Ratecast is predicting. The yellow is our uppercase scenario and red is our lowercase scenario. The blue, of course, is the rolling 7-day weighted average for historical rates for loads moved over 550 miles, excluding fuel. So let's start with dry van. Ratecast is predicting rates to be flat out 35 days. That's an improvement on last year when rates dropped 3 cents per mile in the next couple of weeks before rising to be about a penny per mile down over the same forecast range. So the forecast is a little bit more positive this year compared to the forecast this time last year. The good news is the gains in recent weeks are forecast to be maintained rather than dropping off. So that leads us into the start of shipping course as we get ahead of Thanksgiving. This will take us to about November 16. Of course, that's about a week ahead of Thanksgiving when we start to see a lot of volume of freight moving. The best case scenario in yellow on our forecast up 5 cents per mile, worst case scenario down 4 cents per mile. But this is tracking pretty much what we'd expect to see seasonally in dry van. In the refrigeration market, substantial gains, as you can see there. The model's forecasting rate cast to be up 9 cents per mile through the week before Thanksgiving. That's fairly normal for that time of the year. High case is 15 cents a mile. Low case is still up 4 cents a mile. Last year, rate per mile for reefer went up 8 cents per mile over the same time frame. So we're not seeing a lot of difference in the forecast last year to this year. Probably a little bit more optimistic. Rate cast is certainly on track based on what we typically see as fall produce, Thanksgiving, shipping of fresh turkeys and other commodities start to move ahead of Thanksgiving. And in flatbed, the rate of decline is slowing from prior weeks. Ratecast is seeing a 6 cent per mile decline. Last week it was 9. It suggests rates will be around 10 cents per mile higher than last year by the time we get to mid-November. Best case scenario is they'll be down 3 cents per mile compared to last year. So that's it for the forecast. We want to get to Chad now and start to talk about what's happening in the contract freight market.
Yep, thanks, Dean. So everything Dean's gone over so far is from that broker to carrier perspective. I'll cover the shipper to carrier or broker perspective here. Dean, it was good to see some good news there, potentially for reefers with those rates coming up for carriers. Could be some bad news for shippers as those rates start to tighten up. So it depends on which seat you're in. So what I'm covering here in this first slide is weekly shipment volumes for van in blue versus which is contract, and spot, which is in yellow. So this is that mix between spot and contract from shippers. And as you can see, this goes all the way back to 2016. We're currently at 24%. We expect this to rise as the market does start to tighten. And I'll show you in a few slides a historical trend that shows that a little bit more clearly. The spot premium ratio there in black is that premium that spot rates demand above or below contract rates, currently sitting at -9%. When this pops up over 0%, that's a clear signal that contract rates will be on the rise as spot rates rise above contract rates. Now on to temp control. We're looking at a 15% mix of spot rates and 85% contract rates, slightly up, and a -9% on spot premium ratio. So still depressed spot rates below contract rates in temp control. We do see somewhat of a trend up, but a little too early to tell on that. And then on to flatbed. Always highly variable, as you would expect with flatbed, short-term lanes, seasonal lanes, and that sort of thing. So we have 35% mix on spot, 65% on contract, and -7% on that spot premium ratio, still below 0. And then finally, this graph is all modes combined, and it goes back to 2016 by quarter. And this shows you a little bit more clearly that boom and bust cycle. This is that percent of spot load mix. What's interesting about this, and I covered this last week, thought I'd touch on it again real quick, is those low points. So going back to 2016, 9.3% low mix during that trough in the market of spot mix. And then 2019 up to 10.7, and now in most recently in 2024, 14.1. I think I have a typo in there. The last data point is saying 2019. That should say 2024. But if you look at that most recent quarter there, ending in September, elevated spot mix. So it becomes a little bit more clear when you zoom out from the weekly charts that I was just showing in blue and yellow. So I wanted to just point out that most recent point. We are seeing some tightening, some increased mix in spot shipments on the shipper side. That's it from a shipper perspective.
All right. Thank you, Chad. All right. Let's bring Paul back in and get into some of the macroeconomics. Paul, At the JSC Inland in Chicago, you hosted a really good freight session. I loved it. Can you recap for our listeners what your outlook was for the US economy and freight demand in general? Sort of put it into maybe two sections, the rest of this year and what you see coming into next year.
Yeah, thank you, Dean. So at Inland, I presented what's our current forecast as of last month. We update forecasts every month but with a quarterly and an annual frequency outlook for performance of the U.S. economy as a whole. And we are forecasting that growth in the U.S. is slowing and will continue to slow on into 2025. This is consistent with expectations of the lag impacts of these very high interest rates we've had that have just started to come down, but not dramatically and not very quickly in terms of the impact on the economy. There are signs that the fourth quarter that we're in now will see growth slower than we saw in the third quarter. And from the first half to the second half perspective for the U.S. economy, slower growth in the second half than the first half. This is a reflection both of a slight reduction in the pace of consumer spending. Consumer spending is a big part of the U.S. economy. It's been resilient and amazingly strong actually through 2024. But there's some signs that some of the pace of that growth is going to slow as we get further into the fourth quarter and then on into 2025. Consumer credit, for example, is showing some moderation from the growth that we had seen that supported a lot of that consumer spending. And then also in the economy, and importantly for freight, is the manufacturing activity, some of which is a reflection of investment, some of which is a reflection of inventory strategies on the part of supply chain managers. We are seeing what we've seen actually as part of this freight recession we've been in, if at least want to characterize it as that for a while, is very low growth in manufacturing and industrial production. That support for the movements of components and supplies that feed into supply chains in manufacturing has been weak. In fact, in some periods actually was negative in 2024 compared to 2023. We are forecasting a very weak, but a recovery in that headed into 2025, provides some basis for growth, but still predicated on some big assumptions like that we will have trade policies that will allow our current forecast growth in exports compared to in 2025 compared to 2024. Another factor that is significant is the front loading of imports that we've seen in 2024 for a whole host of reasons, not the least of which was the recently resolved East Coast, Gulf Coast longshoremen contract negotiations, which actually is not fully resolved. That's really pushed into January as far as trying to resolve that. But as far as the freight demand goes, that means there's some payback for some of that shipping activity on the import side that was moved forwards. There's not an equivalent sustained demand behind that to continue the pace of growth that we saw earlier this year, and that continues on into 2025. Yeah, go ahead, Gene.
Yeah, I'm kind of trying to digest all of this. We kind of read a lot of different reports, and most of us feel like the spring of next year will see, some seasonality in the freight market return. Your forecast would suggest maybe that's a little bit optimistic. Would you agree with that?
Well, no. By no means does seasonality go away. We are always go through the slow period at the very end of the year and into January in the winter. But we would say that the difference in terms of the trough and what we see as that seasonal recovery will be more muted in 2025 than we saw in 2024. We're not forecasting recession. We're not forecasting really even anything that you would characterize other than as a soft landing. What we're characterizing is more of a return towards more sustainable trends of the economy, not running in the aggregate as fast as it has in 2024. Now, the big question, of course, where's the disconnect? If the economy is doing so well with this 2.6% annual growth rate, where's that growth been coming from? It's been on the services side. And that's part of that story I said at Inland, where we've really been through a period where after that pandemic period of consumption of goods and the enormous boom and congestion and headaches that we faced in goods supply chains, that services proportion of the economy, which is the majority of spending of the economy, had come back strongly. It's also where demand has stayed higher. It's one of the reasons inflation has been sticky. has been services inflation has stayed higher, unlike goods where some categories were actually in disinflation. That's a reflection of that overall composition of where the strength of the economy has been. So as we move into 2025, we do expect to see some of that seasonality is still there in an economy that's still growing, but now growing at a slower pace.
That's a good point. Yeah.
Interesting. Hey, Paul, I wonder, as it relates to ocean freight, I think I saw that ocean rates are down about 30% since July, which is interesting with this front loading concept, which I assume is some increased pull forward demand as shippers looked out towards the potential port strikes. Do you think that this could, if that demand is not sustainable in the long run over the next 6 months, could that continue to depress ocean freight rates?
Yes, absolutely. And I would add that there's also been some, perhaps not quite as highly advertised, advanced movement of goods that may be subject to higher tariffs.
Mm-hmm.
So it's not just been a mitigation against
Yeah.
a longshore strike risk. And then the disruptions from things like we saw with the low water in Panama and the effective closure of the Suez route. Supply chain managers, after being through all the horrible experiences of the pandemic, trying to mitigate risk by moving things ahead. Well, there's the payback for that, and it's coming in terms of not having the ability to sustain that extra level of demand in 2025. And I should add, on the supply side, the ocean carriers or the vessel operators ordered an awful lot of tonnage and new vessel construction back in the peak of the pandemic, and not all of that new ship construction has entered into the market yet, but it continues on. If we look at the order book for new vessel capacity, it continues to come into the market into 2025. Those order books still play out for a while. That extra capacity that was in the marketplace was really used up by all that diversion around Africa when the closure of the Suez happened, approximately in 2024. That's not repeatable as another increment of demand, barring some other black swan geopolitical event that would shut down shipping somewhere else in 2025. So we're back to what had been forecast originally before the Red Sea disruptions 2024, which is additional supply coming into the market, which gets deployed on vessel service routes, which leads to even further reductions in ocean shipping rates. It's a good news story for ocean shippers in 2025, not so much for the carriers.
Well, speaking of black swan political events, as you think about fuel and the different scenarios that could play out with what's going on in the Middle East, do you have a couple scenarios in mind and how they could affect truckload rates in the U.S., say?
Well, if we take into account the fuel surcharges, absolutely, there's potential. We have relatively low oil prices now because of some of the softness of demand and adequate production. In fact, in OPEC, probably some cheating on quotas. And others, the Russians are able to evade sanctions and export oil. Globally, those oil markets are adequately supplied. But there's, clearly some potential further disruptions in the Middle East if something were to happen more to cut off the Iranian supplies into the oil markets or other disruptions. There's a lot of potential upside risk. There's speculation that we have around an upside risk where perhaps some other disruptions in the Middle East in terms of the battles within OPEC and OPEC plus on those supply quotas and what the Saudis and others may choose to do in terms of production. So there's clearly some upside risk there that's in always volatile global oil markets, and not a tremendous amount on the further downside longer term, but there could be. There's a scenario where actually oil prices plunge a little bit, almost an echo of what we saw back in 2020, where you have perhaps some competing overproduction from some of those oil exporting countries, which then drive supply up and therefore prices down even further, but not for a very long period of time. That would be as part of a battle amongst oil exporting countries to try to gain some market share and get control again of production quotas.
It's very interesting, Paul. You touched on some of our earlier market cycles. We've been forecasting that our movement of rates looks a lot like 2017 did because of some of the externalities that were one-offs in 2018, ELD mandate, changes in the tax code, and then, of course, the pandemic. Can you sort of compare and contrast the industrial economy of 2017 with what we're looking at now, given your forecast? Are they similar?
Well, there's some similarities in terms of some periods of weakness, but with some recovery coming
Mm.
in 2025. But as I said earlier, not a strong recovery. If you think of where we were leading up before the pandemic, we'd had some sustained periods of growth, except that you had some weakness on the freight side. That headwind is still there in
Yeah.
terms of what the freight markets face in 2025. And I would say that some of that, perhaps more so than back in in that period, we were in a period of new tariffs being applied. You had tariff effects that were affecting goods markets, especially in that 2017, 2018, 2019 period. Depending upon the election outcome, we may have something even more dramatic than that in
Mm.
terms of what would affect global commodity markets. And remember, this is important to keep in mind, is it's not just the tariffs that the U.S. imposes on their foreign trade partners, it's the retaliatory tariffs
Mm.
that are imposed on U.S. exporters in exchange. And we're seeing that, that happens every time tariffs are imposed somewhere, there's retaliation. It's going on right now between Europe and China, where Europe is imposing some new tariffs on China, and mainland China is responding with retaliatory tariffs on Europe. That will happen and we've seen even under the Biden administration some additional tariff imposition. So in some ways, no matter who wins the election, there's a risk there in terms of having some impacts on goods flows tied to international
Mm.
trade.
Some rumblings down on the Gulf Coast about the tariffs that have jumped up to 25% on some of the new gantry cranes that are coming in from China. I think it's the big manufacturer of those big ship-to-shore cranes that we see. I think went up from 5 to 25% in the last year.
Yeah, and there's a further consideration of some federal funding links to ports or terminal operators that are purchasing new port equipment that may require some additional
Mm.
Build America requirements, or some tariffs with some waivers that would put some more barriers on the price side to
Mm.
that equipment. And ultimately, the shippers are going to pay for that. It's just a matter of how quickly and how much the U.S. is willing to go down that path. In some cases where there's no U.S. suppliers that exist right now for some of that equipment.
Mm. Yeah, this is fascinating. We've been talking a lot about a return to. In fact, I was talking to Bill Cassidy about it last week. A return to normal, but I said it's kind of like a very different normal. I'm not sure it's a normal like we've been used to, but it's nowhere near what we've seen in terms of the upheaval that we saw during the pandemic. And we were trying to compare and contrast what year it looked the most like. And I think we're sort of for a long time we thought 2018-19 was more appropriate in terms of the upward downward rate movement, but it looks like it might be more like that 2016-17 scenario, given some of the things we're seeing with capacity exiting and demand sort of continuing to move sideways.
Yeah, I think you're right on the fundamentals of the freight market, with what's the capacity that's deployed and where the economy is. I think the bigger picture macro view, I've given up on trying to say there's any return to the normalcy of the 2010s. We're in a new world that's different composition. There's too many factors that have permanently shifted in a way that there's no going back to, say, 2019 or 2017 in terms of the structure of the economy, the behavior of business, attitudes of consumers, things like e-commerce, and then the whole system of policies. We have new industrial policies that we really haven't had for a very long time in the United States. Some other factors that are work that really demand that we supply chain managers and others adapt to the new structure of the economy, the consumer business decision making that is different from where we were all before the pandemic.
Mm. Yeah, one of the big things we've seen is the proliferation of power-only capacity that got a real boost during the pandemic. And of course, it still exists today, but it's a very transient cohort. If you've got a truck, you can jump under almost, not all trailers, but more trailers than most. We see that moving around a lot between dray and dry van, sometimes reefer, but it's a big part of the economy. It was sort of the biggest part of the economy we saw grow, or the truckload capacity economy. And it's been the biggest cohort that's been exiting the market. And that looks like it started to slow right down. I expect on Bill Cassidy's Journal of Commerce Truckload Capacity Index, it'll start to flatten out when he analyzes all of the earnings calls from this third quarter we've just ended. Looking forward to that data point.
Yeah, I think that'll be a good indicator of the latest direction. There's clearly some room for some additional capacity to come out.
Mm,
We're not quite there yet,
mm,
in terms of what's possible to happen in the marketplace. And there's even headwinds there in terms of those that are making investments in equipment, with regulations at the state level and some
mm,
other uncertainties that weren't there before. But you've covered that, I
mm.
know, previously. I don't have a lot
Yeah,
additional of insight to add to that.
yeah. Yeah, the big part of that, I mean, this leads right into the election and some of the rumored changes that a new administration might make around EPA regulations.
Mhm.
Of course, a lot of the new truck order pre-buy side on the private fleets has been fueled by the 2027 EPA regs that are coming out that'll add substantial cost to a new truck. So our partners at ACT Research were reporting that a lot of the growth in Class 8 truck orders this year had been on the private fleet side, largely because their vehicle cycle is sort of 8 to 9 years, which of course
Mhm.
spans 2027. So they were buying up a lot more trucks, and that makes it very difficult, I think, to even use new truck orders as a reliable indicator, because there's so many external forces driving the acquisition of new vehicles.
Yeah, and we'd acknowledge as well as a factor there is that this growth, relative share growth of the private fleets, where they have gained some share from for hire,
Mm,
and that's then gets reflected on the equipment side, like you were mentioning.
yeah, yeah. Chad, anything else to?
No, I think that's great. I appreciate you
Yeah,
being on here with us, Paul. This has been really helpful.
yeah.
Thank you,
We could.
gentlemen. I hope you invite me back. This is great
Yeah,
opportunity to talk to your audience. So thank you.
love to
Yeah,
have you
Paul,
back.
before we go, how can people get in contact with you if they want to reach out to you?
Well, spglobal.com is the domain name. I'm on LinkedIn, and you can find me at paul.bingham@spglobal.com as my email address.
All right. Okay. So before we wind up the show today, don't forget, Chris Kaplis has got a really good show out this week. It's out Thursday. He's talking to Erica Voss, DAT's very own Chief Information Security Officer. She's got some amazing advice for those that are looking at fraud in the freight market. Don't forget, DATCon is next week. We'll see you all there. Next week's show, Adam Wingfield from Innovative Logistics is on. He's a great guest. He was also speaking at Journal of Commerce Inland. Make sure you sign up for alerts to our show, subscribe to our channel, and with that, another show is in the books. Be safe, be nice to everyone, and we'll see you next week at 10 a.m. Eastern, 7 a.m. Pacific.